Hello and welcome, everybody. We're bringing back an interview series that we started last week to discuss what happened at Silicon Valley Bank. As you all have been reading the newspapers and watching the news come across your phones, there's been more developments in the world of banking. And this time, we're going to delve into what's been going on overseas in Switzerland with Credit Suisse, what we're calling Credit Suisse and the Bailin, what happened and what is next. And the point here is to give a bit of an explainer of what is happening in the news today. We're very lucky here at the Psaros Center for Financial Markets and Policy because we have an expert in-house, Dr. Manmohan Singh Kumar, who knows a great deal about Credit Suisse, which we'll get into in a minute. But I want to give a little bit of his background. He is a special strategic advisor at CDPQ, a global investment fund. And until recently, he was senior vice president and a member of CDPQ's US board, as well as a managing director and chief economist. Formerly, he was also a senior official for over 20 years at the International Monetary Fund, or IMF. He has his PhD from Cambridge University, where he taught for 5 years. And he's also been a visiting professor here at Georgetown University, as well as Harvard University. He served as director at Credit Suisse many years ago, but he's got a fantastic insight. And he also is the author of several books and academic papers. He's also chairman of the Sikh Human Development Foundation, the US-based educational charity providing university-level scholarships for low-income families in India. And we're going to actually we're going to use all of his vast knowledge, but we're also going to dip a little bit into his time at Credit Suisse here today. But I think the biggest point that we're going to be looking at today is to answer just the big question in the news: what happened and why? And so we're going to start today with our first question with Dr. Kumar here. Manmohan, why is the crisis at Credit Suisse important?
So first of all, many thanks, David. It's a pleasure to be here. And many thanks for your kind remarks. Now, it's a very, very important bank, Credit Suisse. It's actually it was, one should say now, the second largest bank in Switzerland. Together with UBS, Credit Suisse is regarded as a pillar of the Swiss financial system. It had assets of almost $600 billion. It was a global asset manager, global investment bank, and it was regarded as a systemically important bank globally. So there are, as you know, there are 30 systemically important banks, and Credit Suisse was one of them. So given the size of its bank, given its role in Switzerland, and very importantly, the interconnectedness and all the other financial interactions with financial systems throughout the world, there was a real concern that were it to go under, this could roil not only the financial markets in Switzerland, but have very severe consequences for the global financial sector, for global banks, and for the global financial markets.
That's a great overview to help us to get into the topic. Thank you for that. Can we just go a little deeper? Can you explain what led to the troubles at Credit Suisse? What were the key factors, and what were some of the underlying causes?
So, the immediate factor was really a collapse in confidence. Credit Suisse was losing, it's estimated, around $10 billion of deposits a day over the past week. Going into the weekend, it was a very, very significant flight of deposits. But there were two specific factors which happened last week. One was on Tuesday, so just a week ago, it released a statement. It indicated that there was material weakness in some of its disclosures. And that clearly spooked the markets. And then secondly, just a day after, the Saudi National Bank which is actually Credit Suisse's largest shareholder, said that it was not considering adding to its capital or investments in Credit Suisse. Now remember, this is last Tuesday and Wednesday. You are seeing this huge outflow of deposits in the wake of the banking crisis in the US. Okay, you had the Silicon Valley Bank and then, Signature Bank and First Republic Bank. So investors were very jittery. They were on edge. There was a lot of concern about, the state of health of the banking system generally. Okay, so you have that at the background. You have the concerns about Switzerland. I'll go Credit Suisse. I'll go into that in a minute. Underlying concerns, and then you had these two events. And so that really meant that there was a very, very sharp downturn, essentially a collapse in the stock price of Credit Suisse. It fell 24% on Wednesday. The Swiss National Bank actually came out with a very strong support, over $50 billion that Credit Suisse could draw on. And that stemmed the tide a little bit on Thursday, but then on Friday, it was very clear that this was going to be extraordinarily difficult to stabilize things. Now, this is the sort of the near term, okay? You'd actually had problems beginning many years earlier. In 2008, Credit Suisse actually came out of the global financial crisis pretty well, actually much better than many of its peers. And that sort of, in a sense, emboldened it rather too much. Credit Suisse has always been an entrepreneurial bank. Risk appetite had been generally pretty high, and it became higher still in the wake of, the way it came out of the 2008 crisis. So risk management techniques were not, as they should have been. There have been a lot of scandals. There were a number of attempts and restructuring. They had failed, and that actually harmed the credibility. So going into late last year, in October even, so you're talking about 6 months before, the events of the last week, you had a substantial pullout of deposits from Credit Suisse. And, Credit Suisse tried to, reassure depositors, tried to reassure its customers, but clearly the underlying problems were severe. So in short, great crisis of liquidity, which was a real concern that this would turn into a crisis of insolvency.
Okay, thank you for that. So that does lead to the question, Dr. Kumar, is this contagion from SVB and Signature Bank? Did rising interest rates play a role, or is this something totally separate, or at least not really as associated as one might think?
Well, as I said, contagion certainly played some role, okay? Now, Credit Suisse, on the one hand, and Silicon Valley Bank or Signature Bank, they are quite different in terms of their operations. Silicon Valley Bank, local, essentially US-based, but in California, playing a very important role in financing tech and so on. Credit Suisse, more diversified, bigger, much global, global bank. But certainly the developments in the US. You remember, it all seems a long time ago, but it was less than 2 weeks ago, on 10th of March, that FDIC took over Silicon Valley Bank, right? And it was on the 12th of March, just 9 days ago, that, following serious concerns about developments in Signature Bank and First National Bank, that you had the Fed, the Treasury, the White House, FDIC guaranteeing deposits all deposit, not just the insured ones, 250,000, but all deposits in Silicon Valley Bank and the Signature Bank. And this spooked, on one hand, it sort of gave some reassurance. On the other hand, it spooked investors, spooked depositors of what was going on. And so clearly that that played a role. Now, with regard to interest rates, now clearly, the Fed and other major central banks have been raising rates now over the past year. And, coming from, an environment where for almost a decade and a half, coming out of the global financial crisis, rates had been near zero. And in real terms, they had been even negative. You had this very sharp increase in inflation, and to fight that, quite rightly, there had to be a significant response for monetary policy. And when you raise rates like that so quickly, there is going to be a very significant impact on assets, on asset valuations, and of course, banks, would be affected and were affected. As Ken Rogoff has, suggested, that there's bound to be very substantial, significant repercussions in the financial sector, and that's what we are saying. But I think one has to be a little bit careful that in the case of Credit Suisse, the direct impact. So there's a very significant impact on its assets. Bonds, equity, asset holdings. But, it was hedged to a considerable extent against interest rate increases. Silicon Valley Bank was not, as far as we know. Okay. So yes, there's sort of a contagion effect for sure, impact of rising interest rates for sure, but the extent of that, would suggest that the Credit Suisse specific problems were the most important ones.
That's really helpful to understand. I appreciate that. So I want to go into a little bit about what actions the Swiss government did play. There's been talk in the press that this is not a bailout because it's not the government coming in and bailing out a financial institution. Some are calling it a bail-in, but by that they're meaning they're encouraging another private bank to basically take over. And we've talked about this. Is it a merger? Is it a takeover? It depends on your perspective on that. But I want to ask about that, but also want to ask if there's anything specific about the terms that you'd like to highlight for the viewers.
Yeah, no, that's a very good question, David. I mean, one thing is very, very clear, that it was a forced action, forced by, the Swiss financial authorities, FINMA, regulatory authority, and the government, for UBS to merge with or take over Credit Suisse. I think this is something which Mohamed El-Erian has emphasized very strongly. I mean, it was pretty clear on last Wednesday, that things were going south very, very dramatically, and there was a clear possibility of a Credit Suisse going bankrupt. So then, you can have a sort of takeover by the regulatory authorities, and it would be a very messy, workout. You could not have a repeat. I mean, this is the largest banking crisis amongst the largest bank since 2008, right? You couldn't have a Lehman type of event, right? So you had to have this sort of, if one wants to call it a bail-in, a forced action on, a requirement on the part of the government from and the regulatory authority from UBS. Now, it was, going by sort of anecdotal evidence, it was pretty clear that UBS was not at all keen initially But there was too much at stake, as I said at the beginning. Too much at stake for Switzerland. For Switzerland's reputation as a very sound financial center. Too much at stake in terms of global contagion and so on. So it had to be done, right? And so to avoid panic, and what the Swiss authorities did was actually provided pretty significant incentives and backstops. And it's also, by the way, is interesting that they were keen. In fact, more than keen, they were determined that it should be only another Swiss institution, and only UBS, fit the bill. So UBS essentially, taken over, or you can say merged with Credit Suisse. It's paying essentially 3 billion Swiss francs, around 3.2 billion US dollars for the bank. And it's worth noting that the Friday before, or rather, just a week earlier, it was the market cap was 8 billion of Credit Suisse. Okay, and a few years earlier, the market cap was 60 billion, or even higher. Okay, so 3 billion. UBS is paying for that. And then the terms, there's sort of quite a lot of detailed terms and so on. But just to note that, in terms of bail-in and bailout, UBS would absorb the first 5 billion Swiss franc of losses. Then there's a backstop of 9 billion, which the Swiss authorities would have. And then losses after that would be split evenly, okay? And then Swiss National Bank also has lent 100 billion Swiss franc to UBS, to facilitate this merger. Now, there's another quite extraordinary step, and that's, again, something, it doesn't sort of fit into the classic category, that whilst of bail-in and bailout, whilst the stockholders, the equity holders of Credit Suisse, they've suffered very big losses, very significant losses, over the past week even. They still have, their holdings are still worth something, okay? But you have a certain class of bondholders, normally, bondholders are more senior to the equity holders, okay? Certain class of bondholders, and these are what's called the additional tier 1 bonds. It just means that these are special types of bonds which Credit Suisse had issued, okay, which would be worth zero in case there was a crisis. And that's exactly what's happened. That FINMA, the Swiss regulatory authority, has said that the value of those bonds is actually zero. It's an extraordinary step, and it has come back, out since then, saying that this was really just very, very specifically, for this merger, and European regulatory authorities have also indicated this is not a trivial market. It's around $250 billion or more bond market, these special types of bonds, and they've said no, really equity would be junior to bonds, right? But this is, I think this is quite a striking set of terms. And I should emphasize that, this was very hastily arranged. So the many details still have to be worked out, right? Mm-hmm. So between Wednesday, even as late as Saturday, by the way, I mean, if one reads the sort of the various accounts which have been which have been out there, is that UBS wanted to pay even less, and Credit Suisse was saying that, look, our we have assets worth 550 billion or something, and liabilities worth only 500 billion. So, the bank is worth 50 billion, but UBS wanted to pay much less than even 3 billion. Mm. So details still have to be worked out. But the broad contours are very clear, and it's also very clear that this, it's a historic event, but it has stabilized markets for now in Switzerland globally.
Great, and that leads to my next question. Stepping back out a little bit, what are some of the larger consequences here for not only the Swiss banking system, but also let's say the European banking system and global banking system?
So I mean, for Swiss banking system, so it will stabilize things. There's this issue of concentration, in virtually every city, not in virtually every city, in every city, towns, and even in villages, you had two sets of branches, one belonging to UBS, one belonging to Credit Suisse. The regulator has said, to overlook this issue of concentration. It sort of maybe have some impact on Switzerland's reputation, but I doubt if it will be long lasting, right? I mean, it's otherwise very, very sound and very conservative, financial system. I think in terms of, for UBS, by the way, UBS now becomes the second largest asset manager in the world. Over $5 trillion of assets. The largest asset manager is, of course, BlackRock. And so UBS, would take over, all the assets, a lot of uncertainties and so on. And some are wondering if it's going to be straightforward. In fact, it's not going to be straightforward, to absorb the operations of Credit Suisse. Details are still being worked out, but it was a decisive action. It was a decisive action by Switzerland, as it was a decisive action earlier, week earlier in the US, by the Federal Reserve, by the Treasury, and of course FDIC. Now there are a number of aspects of this, or number of issues. I think first of all, as I said, it has calmed sentiment quite a bit, and you've had Janet Yellen and Jay Powell, emphasizing that as far as the U.S. banking system is concerned, it's very sound, and it is. I mean, things are very different compared to 2008. Okay, and globally, I think it's this merger has stabilized sentiment. The capital and liquidity ratio of the largest banks is much better. It is also the case that the speed with which this has happened, right, has raised questions about what could the regulators, the authorities do to prevent things unraveling so quickly. Some are saying, well, this is the result of, the digital transactions. You can yank your deposits out, literally at the press of a key, right? And, to have sort of 10 billion of outflow a day, right? Maybe it's only possible, with the digital environment we have and the social media, rumors of swirling around and so on. And in that context, it is being suggested, and, Janet Yellen, the Treasury Secretary, made a speech today saying that, in terms of the small and medium-sized banks, maybe, they would consider, or one at least needs to look into the possibility of increasing the limit temporarily, from this 250,000 to more, for depositors. So, the depositors feel comfortable that, there isn't going to be, they are not going to suffer losses. I think in terms of the broader consequences, you've had this sort of stabilization in sentiment. This is being reflected, 2 days after. It's not, the day isn't quite over yet, but, in the markets. But I obviously, it raises questions, what other sort of problems there might be in the banking sector, in the financial sector, given the issues we've talked about, including the very sharp increase in interest rates. Now, it is true that the banks are now going to be more cautious in lending, especially the small and medium-sized banks, which, if they look at the US, play a very, very important role. Okay, they're going to be more cautious. So this is going to lead to a tightening in financial conditions. Okay, and that would then obviously have an adverse impact on economic activity. It's also then raises a question of, okay, how does monetary policy respond? And as you know, the FOMC is meeting tomorrow, today and tomorrow, and there's going to be, all eyes are on whether it will raise rates or whether it would be on hold. I think the broad consensus appears to be that unless something very dramatic happens between today and tomorrow, given that inflation continues to be serious concern, it will probably raise rates by 25 basis points. Don't forget that last week on Wednesday, ECB actually raised rates by 50 basis points, as it had said. And, it's a sort of important, I think Raghuram Rajan has emphasized, this is a sort of like an important dilemma, that if the Fed doesn't raise rates, then investors and, depositors and so on, public at large will think, hold on a second, do they know things we don't know? Are things really, there are other skeletons in the cupboard as far as the banking sector is concerned and beyond. And so it's a very difficult situation for them. But, I think regardless of that, it's pretty clear that although the US economy has been very resilient so far, this tightening of policy, and that's the objective, to bring down inflation, there will be a slowdown in activity. Tightening of policy and then this tightening of financial conditions, would have an adverse effect on economic activity here and broadly.
Well, this has been a great conversation. Thank you, Dr. Kumar. I think we'll do just one brief little, you made great reference to the fact that Treasury Secretary Yellen gave a speech for the American Bankers Association today. This is Tuesday, we're filming this. Tomorrow, the Federal Reserve is going to be announcing their decision. But I guess the one takeaway quickly is, do we feel like, when we're talking about broader implications here, contagion on policy, is this the end or is this the beginning?
I would certainly like to think that, this is not the beginning. As I said, the situation today is very, very different from the situation in 2008. And frankly, the speed with which the authorities have acted in the US and then in Switzerland, indicates that they are totally on top of it. In the interim, from 2008 onwards, bank balance sheets in general, especially of the systemically important banks, and Credit Suisse, as we've noted, there were some serious issues, but those balance sheets have strengthened very significantly, right? Nonetheless, given the speed with which interest rates have risen, after having been, virtually zero or in real terms negative, and now they could end up being positive. And it depends, how far the Fed goes, right? If the Fed does want to bring inflation down to 2%, right, would it keep tightening policy further, or would it say, okay, look, we've done a lot. Let's say inflation is at 3%, and then there's a pause. Okay, that obviously will have different implications. But I think I really don't think the probability of further very severe turmoil in the financial markets, in the banking sector, I think the probability has to be low. Right, small and medium-sized regional banks in the US, I think there could be pressures, right? And it could be that you'd see volatility, You would see volatility for several weeks, possibly even several months. Okay, but for the time being, I think, and I mean, unless you got a very sharp, unless an accident happens somewhere, right? You got a very sharp sort of collapse in confidence again, and so on. I think the baseline has to be that for the time being, at least, this is closer to the end.
That's
if
great.
not.
Thank you very much, Dr. Manmohan Kumar. Thank you very much for joining us for this explainer. Everybody, thank you for watching. We hope to do more of these. Please keep an eye on this YouTube channel for more, as well as our Twitter and LinkedIn pages. And you can always find us at the web address that will be on the screen. Thank you very much from the Psaros Center for Financial Markets and Policy.